present this paper in the afternoon because the level of attention of presenting soon after lunch is usually at its peak. So this is a joint work of Camilla and myself. May I add by saying that this is the first partnership we've had in terms of collaborating for research, and I think it has been very enjoyable. We will do a joint presentation, so I'll basically introduce the paper, and then at some point I'll call upon Camilla to highlight a small component, but very critical component of the paper, because it's at that point where if our findings are valid, then we take credit. And if the findings are not making sense, then she takes the responsibility. And then I'll come back and offer some final thoughts on the paper. So as already mentioned, the paper is around monetary policy at the turn of markets. Markets are always on the move. The turn of the markets is usually in the context of when they are making a fundamental shift. Because markets, depending on which market you're talking about, can be moving on a daily basis, sometimes on a monthly basis. But when they turn a corner in a substantial way, one has to step back and look at what that means from a policy context. And the essence of this paper is really to look at whether that turn is motivated by the conduct of monetary policy, or whether monetary policy responds to markets once they have made the turn. It's a very simple, one objective paper. So what I'll do is I'll offer some introductory remarks giving the context of the paper, and then I'll spend a few minutes giving them high-level model that informs the thinking around the subject, that then will form a basis for our empirical investigation and findings, upon which we will make inferences. I know a question was asked as to whether what we do here is policy implications or policy recommendations. As far as I can tell, researchers are usually very modest people. They don't want to jump into making policy conclusions and recommendations before it goes through a certain process. And I think if you understand the policy making in any economy, in any government, that's the closest you come to the sausage factory. You don't know what happens behind there, you just see a policy happening. And sometimes researchers come to either critique a policy that has been made without necessarily going through the process of doing a study and coming up to policy recommendations. So I think we'll make policy inferences and implications of what this entails. So let me start by saying that when it comes to the conduct of monetary policy, often people look at the central bank and how it goes through the process of making monetary policy, among many other policies. The primary constituency of a central bank is the banking system. And the reason why that is the case is because the banking system is the conduit through which the policy is directly transmitted. And often the central bank watches the behavior of banks very, very keenly at the point of making policy. But the commercial banks also watch the central bank very keenly in the process of making policy. So the two are watching each other. That does not necessarily mean that they are watching the same thing and they are driven by the same motivation. The central banks are assumed to be pursuing what you can call a public good agenda, meaning that whatever stability objective that they will be pursuing, that objective is meant to address the concerns of the wider economy. Banks, on the other hand, know the implication of monetary policy conduct, in the sense that it potentially affects the pricing of their products. And as the previous paper pointed out, it could actually be signaling the outlook of some of the parameters in that regard, you can assume what you can call a feedback loop between the central bank and banks, with the regular assumption being that the central bank will signal, and then the commercial banks will respond. But we argue that that is at best an assumption, in the sense that there could be instances where the policy signal is being preempted by market behavior. We have a lot of poets in Africa. I know people in the room love quoting poets from other parts of the world. There's a very prominent musician from the DRC who once did a song. I cannot put it in Lingala, but I can give you a translation of what that song says. And it says that the snake saw the man and it was scared, but it didn't know that the man was also scared. The context here is that you may think that the central bank is one that is looking more keenly at the commercial banks, more than banks are keenly looking at the central bank. But as I've already said, the two are looking at each other in the sense that the behavior of one influences the other. But we also argue that it matters who responds and who signals. The assumption is that the central bank signals and the market responds. And that's an assumption that we're questioning in this paper. Now, in the context of this research, I'll speak to two things. One of them is what I'm calling the known knowns. We know the evolution of the monetary policy framework of the central bank from right at the inception to where we are right now. But I think there's not much to talk about monetary policy conduct at the time when the markets were not liberalized. But when we liberalized the markets in the early 1990s, and we started moving towards a situation where interest rates and exchange rates are market determined, then now there was a process of now thinking about what framework really works. And then move forward to a situation where now we have initially the Monetary Policy Advisory Committee that ended up becoming a Monetary Policy Committee, essentially going into a framework that is aligned to what modern central banking do insofar as policy is concerned. So there's a white paper that was published a few years back, in 2021 actually, around the framework that the central bank uses for conduct of monetary policy. And that framework is really trying to attune the monetary policy framework towards an inflation targeting framework in a more formal sense. In there, of course, is an acknowledgement of the advantages of moving towards that inflation targeting monetary policy regime, but most importantly, acknowledging some of the underlying weaknesses in the framework that they have right now, meaning therefore that there's a process of fine-tuning monetary policy on the back of the advantages and disadvantages or the weaknesses that may be arising in the existing policy framework. But in there is really one fundamental assumption. The movement of the policy framework towards a forward-looking regime that is price-based. Nowadays, central banks, and I'm happy there are colleagues in the room from central bank, don't talk about the quantity of money as a basis for conduct of monetary policy. Instead, they make reference to a price-based regime where that price is an interest rate regime. And now we're in a situation where, with a liberalized interest rate regime and a flexible exchange regime, there could be an assumption that those are adequate parameters that will make this new monetary policy framework efficiently work. So that there's no quarrel about that. The second is what I call the known unknowns. And this known unknowns is not my creation. This was a creation of some American warlord called Donald Rumsfeld, who talked about the known knowns and known unknowns. So the known unknowns, one of them is that there's an assumption that whenever markets are turning, monetary policy is embedded in there. We've seen markets swing even before monetary policy conduct, because markets are usually characterized by either responding to noise or the risk-taking behavior of noisy traders who will make markets turn in anticipation of monetary policy. The other is that we assume that if the monetary policy framework is forward-looking, then the question is that forward-looking nature sufficiently anticipatory of how market turns will happen? So we talk about a forward-looking monetary policy, but we don't have an understanding of whether that monetary policy framework is anticipatory enough so that it's able to provide the signal that then the market can ride upon. Now, if you wanted any cursory or informal evidence as to how sometimes the market can run ahead of monetary policy, just need to look at that graph in front of you. And you could see the red line being the CBR, which supposedly is the policy, okay, not supposedly, actually is the policy signaling rate. Excuse my French. It's the policy signaling rate. So essentially that means that if you see the CPR going down, then the monetary policy is being expansionary or accommodative. And if you see it going up, then monetary policy is of necessity tight. Now, if you look at that graph, the green graph is the 91-day treasury bill rate. And when you see the green moving, sometimes the CPR takes a bit of time before it responds. And that usually happens when you have fundamental market terms, as was the case in the period around 2011-2012, where the market is signaling that you need to tighten, but the monetary policy was it came with a lag. And I think when it's coming down also, you see the market responding faster than the monetary policy response. And that happens through the period when you have major turns. Like when you look at what happened at the time post-COVID, when monetary policy started being very tight, you could actually see the exchange rate moving pretty fast before even the monetary policy moved. This is just a very informal way of saying that perhaps we have to start entertaining the notion that sometimes the market can turn without necessarily getting the signal from the monetary policy. So that is just one piece of information that I think motivates our thinking around this paper. The second is what can call the open economy attribute, in the sense that we are a small open economy, meaning therefore that our financial sector has this attribute of being able to be influenced by spillover effects from what happens elsewhere. So if you look at this chart, you can see that there's a lot of what can call international intermediation, where resources come to the domestic economy from international capital markets and international financiers. And that has implications because if there's a change of regime in those international markets, it's filtering into the domestic market. I want you to look at this in the context of what I said earlier regarding the assumption that if you have a fully floating or fully flexible exchange rate, then you expect that that will be addressed if there is any inflows, the currency will move and everything will go into a self-equilibrating nature. But we understand something called sticky prices, because the monetary policy is underpinned by the desire to have price stability. Then you should have this notion of sticky prices in mind, and there's a lot of literature, credible literature that supports sticky prices, starting from the classic Mandel Fleming. Some people say that it's actually Fleming Mandel because Fleming started this story earlier and Mandel picked it up a year later. And then of course we have had that sticky price argument being supported by further seminal work like a work by Don Bush, what the economists call the overshooting model, and also other work by people like Gita Gopinath. Now, the big modification here is when you talk about sticky prices, you must be very clear. They are sticky in which currency? Are they sticky in your domestic currency or they are sticky in foreign currency? Are they sticky on the basis of the producer prices or they are sticky on the basis of the consumer price? So I think you have to have that in mind. And the totality of that informs what we can call the broader aggregate demand of the economy. And in the paper, we make reference to what we call the aggregate demand friction, because if you have to have monetary policy that is efficiently supporting what you can call price stability, then the aggregate demand angle must come to play. The second is that we have what we call limited substitutability of foreign and local assets, in the sense that if you're issuing a foreign currency denominated bond, that does not necessarily make it a substitute for a locally denominated issuance. And therefore, because of that, and financial pricing, we have what we can call financial terms of shock friction that you have to entertain as you think about that. And then, of course, is the obvious one of sudden stops and quick reversals. In the event of the market, especially in an open economy, reading something about the local developments, you can have a quick reversal of portfolio flows into the economy. And that could actually be informed by what the market reads. And because monetary policy does not respond on a daily basis, you see that feeding into the next cycle of monetary policy change. And I think this is really what you can call attributes of the original scene, when you're a small open economy, and therefore being subject to spillover effects from an external economy. And small open economies have this disadvantage of, you may want to appear like you're managing your local issues, but I think things external affect you. To me, the smallest open economy I know is an economy that existed within Nigeria. If you understand the Nigerian economy very well, there was a republic within Nigeria called the Kalakuta Republic. I don't know if anybody knows the Kalakuta Republic. There was a musician called Fela Kuti who basically made his compound independent of the Nigerian government. The only problem is that it was only independent so far as creating of music and all that is concerned. But I think it relied on the external economy and it was subject to exactly the same things that are depicted in this chart. So I think the open economy attribute is something that you need to start thinking about when you know how markets are going to respond vis-a-vis the conduct of monetary policy. The third is really this idea that you want to map your local savings to the local investment requirements. You, on the one hand, want to be self-sufficient, but inevitably you have to rely on external savings to fill the domestic investment gap, what is called the Felsen Orioka puzzle. And if you look at this chart, what you see is that whereas there's a very strong association between total investments and total savings in the domestic market, the fact that you have a current account that is open and you have a current account that is negative and expanding over time, that negativity and expansion speaks to the extent to which you rely on the external markets to support your domestic savings. And I think this is really giving you the impression that yes, we have an independent conduct of monetary policy, but both the domestic and external circumstances that are interacting will make you be found in a situation where potentially the market could actually be moving ahead of you, especially if the central bank is encumbered by the small open economy attributes. So that is really the context around which we are trying to undertake this analysis. Now, let me give you at very high level the underpinning model, and I'll make this very soft so that we move along together. Many people assume that central banks conduct monetary policy on the basis of what's called the Taylor rule. The Taylor rule was a formulation of an American economist called John Taylor in a publication that was done in 1993 that says that the central bank rate responds to two gaps basically. The output gap, which is essentially the potential in which an economy is growing vis-a-vis your actual rate of growth, and secondly, the difference between your inflation rate vis-a-vis the rate at which the target of inflation that you're given. And the critique of the Taylor rule is that it's a very good descriptor of the past, but it doesn't have the ability to basically give an indication of how the future path of policy is likely to be. And this critique has been championed by, among other people, Ben Bernanke, whom you probably know, very successful academic Nobel winner, and a central banker, having been the chair of the Fed for some time. And I think the biggest highlight of Bernanke's critique of the Taylor rule is that it assumes that monetary policy is automatic. That if you fit into this formula, then I think monetary policy must respond appropriately. But the reality is that monetary policy is not automatic. Instead, it's systematic, in the sense that you consider many other factors and see where you are, and then you adjust. Essentially, you have some discretion of modifying the Taylor rule in such a way that it fits the circumstances of not making it automatic, but instead being systematic. Now, there's a reason why monetary policy is very critical, and everybody watches it. And it's because of the need for monetary policy to do what's called intermediate savings to investments, so that you are at an equilibrium where savings match investments. And in this case, we are talking about savings as being determined by your overall income plus a rate of interest that is equal to your investment requirements, that is also being determined by income, and that very rate of interest, plus other factors. There's so many other factors can come into play. So the one thing that I think is embedded in here is what you call the output gap. The output gap, as I've said, is a measure of your actual rate of growth less your potential. So if it's negative, it simply means that you're basically growing well below your potential. If it's positive, it means that you're overheating as an economy. But the problem is the measurement of that output gap is as accurate as how reliable you measure the potential output. And that brings in an element of subjectivity insofar as the conduct of monetary policy is concerned. The second is really modifying that equilibrium condition to acknowledge that the instances where you want to have a rate of interest instead of having a common rate, you have a rate that tries to close the gap between investment and savings at the point where the output gap is also closing, essentially having simultaneity in the close of those two gaps. And that's what they refer to as a neutral rate. Some people would call it a natural rate, but I think naturality, in the sense that it probably is very long term, but typically it's referred to as the neutral rate. And this neutral rate also serves the same attributes as what you call the output gap itself, because of that determination of what that rate will be. It's not an observable rate, so it has that limitation in it. But suffice it to say that a number of central banks, especially in advanced economies, and we've quoted in the paper literature, substantial literature in the European Investment Bank, the Bank of England, and especially in the Fed, where there's a lot of investment in determining what this neutral rate is. And it's out of that then you see people making observations that, look, maybe the monetary policy is lagging, or maybe the monetary policy is ahead of time. I see the same commentary in the local market by analysts that monetary policy is behind the curve. That's the word they use. What I don't know, or at least what I've not seen, is how they determine what that curve is, so that they're able to establish whether the central bank conduct is ahead of that curve or behind that curve. So this is the second aspect of trying to bring on board this natural rate. But I think what we also have to acknowledge is that both the natural rate and that common rate between savings and investment does not reflect what you can call the risk-taking behavior of the financial ecosystem. So in there, then we have what you can call the risk margin that you had. So assuming that the central bank rate is what is going to determine your pricing of deposits on the one hand, and also your pricing of credit, then you must, of necessity, put a margin on top of that rate that we're talking about. So that therefore means that you have to entertain the idea that if you have to go strictly the Taylor rule way, then you have that double whammy of an observable income potential and also an observable natural rate. And I think this is part of the ongoing conversation. There's this argument that I think started with an economist called John H. William way back in 1931 that says, and I quote, the natural rate is an abstraction. Like faith is seen by its words. One can only say that it's a bank policy, that the bank policy succeeds in stabilizing prices. The bank rate must have been brought in line with the natural rate. But if it doesn't not, it must have not been. So essentially, what he's saying is that you get to know that you've converged the policy rate at the natural rate when you're there. So the pain of trying to determine that rate is actually according to this economist. And I think others, as late as last year, there was work that came out by economists who are doing work in this area. that's why we are proposing in this paper for us to know whether the market really leading or lagging, a substantial modification of the Taylor rule. And this includes recognizing that the central bank, first of all, looks at its past rate as a starting point. So we have the CPR represented here by the R that you're seeing here as a dependent variable. And then a constant, then you have the lag of the policy rates. Then you have what you can call the inflation target differential. I mean, you have a target and you have the actual inflation. That's very easy because the target is known. Then you have the rate at which the economy is growing. You have an exchange rate because of the open economy activity that we talked about. And then you have what you can call the risk-free rate with appropriate lags being embedded in there. And then you also have a rate that has factored in the risk premium. And then you have asset prices being put in there. And then you also have, because of international borrowing depicted in that open economy attribute, the rate of international borrowing that actually take into account the risk premium. And then, of course, the differential between the domestic rate and the international rate of appropriate tenor, of a similar tenor, and an error term. So this modification of the Taylor rule is really going to be the basis upon which we are going to do our empirical investigation. I think that is sufficient justification for us to show you our empirical determination, and I'll invite Camilla to just take us through the empirical side, then I'll come and conclude.
Jared mentioned, the idea is to see what the implementation of the modified Taylor rule would be if we were to put it to the test in analytical analysis. Because we're looking at the effect of monetary policy on financial market behavior, we focus on high-frequency data. Our data ranges from June 2013 to June 2024, and we use monthly data. While there are many methods that are used to look at the effect of monetary policy and to study this, amongst them the VAR itself, more structural models like the DSGE. We actually opted for the structural vector autoregressive model, and we did this because of the three unique features of the SVAR. Firstly, it's structured, so it enables you to tailor your analysis to the structure of your economy. We know that structural factors really impact the effectiveness of policy and how it's transmitted, and that allows for evaluating the different model and how it fits your economy. And in this way, it is actually a better model than the VAR. It is really useful for analyzing the effect of policy on various variables, similar to the VAR. But it also has another special feature that distinguishes it from the VAR, which is the fact that it enables you to determine the type of shock that you're looking at in terms of a policy shock and distinguish it from other shocks that are likely to affect your variables. And I think this will become a little bit more practical when I talk about the results. So in estimating our VAR, basically we did a few things. Firstly, we determined some restrictions. Because we are looking at very short-term analysis, what happens in a given year, we actually use short-term restrictions, and we define our restrictions based on the Keynesian ISLM model and the representation as articulated by the Mundell-Fleming and Dornbusch model. We believe that ordering matters, and therefore we actually look at ordering our variables starting from the ones that are impacted over the long term to the ones that are impacted in the very short term. And we also consider which ones are exogenous, meaning outside of the control of policy, and which ones are more impacted by policy and many other shocks. We know that policy has lagged effects, and so this is considered in our model, and our model is a two-period SVAR. And finally, as Jared mentioned, in the modification of the Taylor rule, we look at exogenous factors, and we include some factors, especially the ones that he mentioned, as factors that are outside of the control of policy. They're external factors, but they impact the policymaker in terms of them taking these factors into consideration in the policy decision. And we include the factors that Jared mentioned, the interest differential between the foreign and the domestic. We look at the foreign participation in our domestic market, and we look at the risk premium that we face in our bonds, external bonds. In terms of interpreting our model, because we are not able to make much inferences from the coefficients themselves, we look at the impulse response functions, and we look at a decomposition about how these variables behave and the intensity, and we also look at how the variables are related to each other. So in terms of the impulse response functions and some of the quantitative weight of them, we find 5 key findings that we would like to share with you. Firstly, we see that monetary policy actually has an impact on the short-term rates as well as the long-term rates. And here you observe the first row, where we see how the different short-term and long-term rates are reacting to a 1 percentage point change in the monetary policy rate, which is the CBR. And the main conduit that we find for the transmission of monetary policy is the interbank rate. We see that in the middle column. And while it actually has the biggest impact of 1.65 percentage point, which is more than proportionate to the increase in the policy rates, we see that it is the main transmitter, and the changes in the longer term rates carry less of the change that is observed from the monetary policy rate. And so this implies that the efficiency and vibrancy of the interbank market is very important in the effectiveness of monetary policy implementation. We also see that monetary policy lowers the inflation gap, and the gap is mainly the difference between the current inflation and the target, and we use the 5% target. And here we see something interesting. The inflation gap is impacted by monetary policy with a 2-month lag, but we see in the second column, first row, that there are other factors that are impacting inflation prior to the implementation of monetary policy. When we try to look at what drives inflation in our economy, we know that there are short-term factors such as weather, and given that inflation is mainly food price driven, we see that some of these transient factors are likely to impact the changes in the inflation gap, even in the absence of monetary policy. And they're also able to resolve themselves. We also find something interesting. Within a 12-month period, the impact on the inflation gap from the monetary policy is about 0.94%. This implies that monetary policy has a very short-term impact on inflation, and this is in line with some of the results and studies that have been found on emerging markets.